All right, I'm here with Wally Conway. No, I'm here with Chad Hett, and he's not Wally, but he's pretty good. Certainly a younger guy, so a lot of energy comes out of Wally somehow. Even though he's got, I don't know, he's got 10 or 20 years on us. So Chad is with Inspection Go. He's one of the founders of Inspection Go, and he's with the Elite Group Home Inspection in Southern California. So if you need a home inspection in Southern California, or you're looking for some good advice on how to run your home inspection company, check out Chad Hett. He's probably at this point, I would say definitely one of the top, 3 or 4 most successful home inspection business owners in the world's history. And no indication that will change anytime soon. So let's start talking about our topic of the day, because a lot of people are interested in this stuff. A lot of people would like to be good at saving for retirement and investing, and they're just not. They go in a lot of different directions. They'll go in the day trading. They'll get into ETFs. They'll get into mutual funds. They'll go and talk to a local broker, and then they'll decide that they don't want to pay the commissions, and then they'll go online. And I think we've all been kind of, if you're 40 or 50 and you have a decent nest egg built up, you've probably experienced almost every type of investing when it comes to the stock market. I'm fairly decent at building a portfolio. I put my stock picks out there. I on purpose have never gone and gotten qualified for it or licensed to do anything because, well, I don't want to be responsible for what I say. But also because I want to be free to say, what I want to say without regulation, without fear of consequences. And I get questions all the time. How do you build a good portfolio? And it's really, really simple. Chad offered to join and have the discussion, ask the questions that you might be thinking at home. So welcome welcome, Chad.
Thanks, Nathan. I appreciate that. And go ahead.
I see your house has a maximum occupancy of 40 there.
I'm actually at a community center here, just utilizing their facility, but yeah.
It makes more sense. I was thinking about putting some of those stickers in my house, just, because.
Yeah.
All right. So, Chad, I put together a few categories, and, you can ask a question or talk about your experiences from any of these perspectives. I think, we at least share in common probably having experienced 3 of these categories at least. And I put these categories on the board so that whenever we're talking about a topic, we can say, hey, this doesn't relate to you if you're in the category of less than $10,000 in your investment accounts. If you're between 10 and 100,000, this really applies, or this is how you should handle this issue. If you're between 100,000 and $1 million, that's usually a very different story than the other 2 categories. We'll talk about that a little bit. And then one category we won't talk about today, we might mention in a couple of facets, but we won't add a lot of time to talk about what you do with millions and millions of dollars to throw in the stock market, because there are very, very few people that ever get there. And, it'd be a waste of most people's time. So let's start with a phrase I'm going to give you, and, and see if test your knowledge a little bit. If I say the Dow 30, does that mean anything to you?
Yeah.
All right. Tell me about the Dow 30. What's the Dow 30?
It's the top companies, that represent the Dow, I guess, the ones that, the blue chips, Apple, American Express, companies like that make up.
Absolutely. Okay. So the Dow 30 are the 30 companies that make up the Dow Jones Industrial Average. And if you go to the last 100 years or 80 years or all the way back to the start of the NASDAQ, of the Dow, of the S&P 500, and you were to compare where these indexes are compared to the overall market, compared to where the dollar is, et cetera, you will see they're all fairly similar, but the most stable one it has been the Dow. And part of the reason for that is it's only 30 companies. They have to be indicators of the entire market, so they tend to be very large companies that are part of almost everyone's life, right? Procter and Gamble and Apple, and JP Morgan. These are companies that that you are a client of, very likely, and also it's been very stable for a long time, because getting delisted from the Dow Jones Industrial Average is a relative rarity. And it was, by the way, founded, it was over 100 years ago that it was founded. And if you were to go in and buy one share of everything, gosh, I forget what it would come out to, but I mean, roughly today, that 32,000, the 32,000 where the Dow is. So here's what I'm going to challenge you to do first, before we talk about, where you are categorically. And let's just assume that you have no interest in, as I don't, in mutual funds. I don't like mutual funds. I don't like ETFs. I don't like the idea of, a huge percentage coming off of the top of a group of stocks that, are we really getting something majorly better with these ETFs and mutual funds? And when you look at their histories and their return rates, the answer is generally no. So, the idea that you're going to pick the next hot ETF is, probably a farce. So let's go with what we know. We know for 137 years that the Dow Jones Industrials have been rock solid, and that every company in them, is in the billions of dollars and isn't going anywhere. And let's take that list of the Dow 30 and let's analyze one or two and see if they're a good fit for a portfolio. Because what are we looking for? I'm looking for things that don't offend my sensibilities. They're not, morally against anything I stand for, or ethically against anything I stand for. And also, I like to add that they're a good financial play. So let's pull up, and these are, today's numbers, which can obviously change, but let's pull up Apple stock. Do you own any currently, Chad?
No Apple. I sold. Yeah. They're just, what is it? 30, 40 times over earnings. It's just very volatile. I'm not liking that stock right now. No.
Yeah, exactly. So let's pull up a really simple analysis of something. We're going to pull up the Apple stock on let's see, on Google. I mean, it's just, simple analysis, and it says what the price is today. And of course it shot up on Friday because they beat earnings expectations, and, and that's fine. I don't have a fear of missing out of that, that 8% for.
Neither did I. Yeah.
For most days, avoiding this, you got a 52-week high. The highest it's been in the last year was 182. The lowest it's been is 129. That's a huge swing. You put in your family's nest egg, money that you might need to pull out for some reason, and you could buy it on a day that it's 182, and the next day lose 30%, or the next week lose 30%, because they didn't hear. Yeah, exactly. It's not only volatile, but going back to the thing that that you said, it's no longer 40. Like, it was 40 a year ago. It was 40. Yeah.
Is it higher?
No, it's 25.48 right now.
Okay.
So
still way too high. Yeah.
It's still way too high. So let's talk about this price to earnings ratio real quick for people that don't understand. And I'm referring to this number right here. Essentially, if you take the company's, profits, and you were to take all of the stock together and say, okay, how long does it take for those earnings to pay off that stock price as an investment? And the answer in the case of Apple, which, it's been enormously higher than this, it's scary, but the answer to that is 25.48 years. Now that's kind of deceiving a little bit though right now, because actually, compared to where it was at 40, I really didn't like that. When it dipped last year, I bought some and then, went back high again, and, just for fun, because it was, part of the Dow anyway. It's pretty safe. And then it spiked, sold it off. But look, they're paying a dividend now. So that 0.6 dividend, does that take your price to earnings ratio and kind of take it down, since you're, in a sense, since you're getting paid back your investment every single year? I think it does, but it's still high. Let's go to a different Dow 30 stock, and let's put up the list for all to see. The Dow 30 stocks. All right, and we'll pick a regular one. Okay, let's see here. There we go. All right, we may be getting into the wrong kind of website there. Let me skip that paid website and go.
Like Amex.
There it is.
Amex looks really interesting. Yeah.
Yeah. Okay. So here we are. And of course, this is after a great day on the market. Let's go to something that's fairly reasonable, and we know it's priced reasonably. Let's go to the Coca-Cola company. That's KO. And let's do the same kind of analysis real quick. I don't think a lot of people are, there's nothing sexy about Coca-Cola, so they're not looking at it.
No. Right.
But your price to earnings ratio is higher than Apple right now. All right.
Mm-hmm.
But Coca-Cola's kind of earned it. You can't have a grocery store, a convenience store, a restaurant without Coca-Cola, and they do well not only here in the US but internationally. Look at that dividend yield, almost 3%. That's another thing you're going to find, for those watching this going, oh man, it's so much more exciting to be in the NASDAQ and have something, just go off like a rocket ship. Well, sure, but those are rare. You're going to lose on a lot of stuff, and your dividend yields just suck compared to the Dow. So, there's quite a few of the Dow 30 that are paying between 1.5% and 3% dividend yields, and that adds up over time. So worth owning. And look at the spread of Coca-Cola difference between that and Apple. From 52 to 67 is a huge difference. So I mean, like, Coca-Cola is on my list. I think it should be on probably everybody's list. Let's pick another one. I think you're gonna find P&G in here somewhere. There it is. PG, Procter and Gamble Company. This one's a little bit more reasonable on the price to earnings ratio, but actually it got up a little higher there too. It didn't. It's up to 23. But it's not crazy. The crazy one was when Apple got up to 40. They needed a smackdown. So I'm glad to see it. But again, I like this one because we're at that 23.4 price to earnings ratio. We're dealing with a company that makes things like Tide, like they are not going away. The next COVID hits and everybody buys all their stuff. And actually Procter and Gamble is a really good one to talk about inflation on. So
Yeah.
here's a company that, these companies are super efficient at inventory, at manufacturing operations. So, when inflation starts to happen and other companies, smaller companies primarily, are kind of fumbling, they're stuck on their inventory. They don't know when to increase their rates for income for new hires. And these companies know how to deliver because they fill the Walmart shelves, they fill Amazon's warehouses, they fill Costco and BJ's, and
Yeah.
they're a machine. So when inflation hits, don't go to gold, don't go to silver,
Mhm.
don't hide your money in your mattress or go into Forex markets. Go to things that are commodity pricing that
Yep.
cycle through really, really fast. Just the simple example. I'm sure you don't even need this explanation, Chad, but somebody out there might. Let's just say
Sure.
that this stock is $100 and that the most gigantic bottle of Tide is $20. And inflation takes that Tide bottle to $22, up 10%, and their
Mhm.
margins come along with it. Well, it's not that the stock market is directly tied to it, but eventually those numbers, work their way back up, and now it's not $100 stock, it's 110.
Yep.
And so you're protected from inflation by companies like Procter and Gamble. It's a great inflation play. And you see this on all the days that the market gets crushed, and Procter and Gamble is sitting there with 0.5% rise. Nothing exciting again, but all you have to do is beat the market every day. So,
Right.
so I'm not going to bore you by going through every single one of these, but let's do a little bit of homework. Let's be involved in our investments just a little bit by going through the Dow 30, finding your favorite 20. Like, make sure by the time you get done analyzing, you have 10 that you've put aside for a day when their prices get crushed down, when their business model changes, when they get delisted and somebody replaces them. Whatever whatever happens to it in the future, who knows? Every day you make the best choices, but let's get a basis so that we can start doing something with our money. And this is where we have to talk about how much money you got. So whether you're at less than 10,000, between 10 and 100, 100 to a million, or a million plus, you want to buy stocks, not ETFs, not mutual funds, and you want to buy when there's an opportunity, when there's a dip. You don't want to buy at the peak. Here's the bad news. Nobody knows when that will be. So this is how I build all my portfolios. I take my favorite 20 stocks, and this is going to sound like a fun game. And every single day and week and month, I'm analyzing which stocks got crushed. And start with, what kind of day was it on the market, or what kind of week was it on the market? If this week the market lost 4%, which is a giant number, and we've seen that in the last few months here, luckily, because I like to buy. I like to buy well. That's when you make all your money. If it's down 4%, I'm going to make a massive move on my capital. I don't care what the future seems to hold. The market overreacted to something, and even if the market's going dwindling down for some unknown reason, and the future is going to be bad, at least I bought on a dip and got a little bit better deal than the other guy, and that other guy could be you. So whatever. we're not actually on the same team here. Like, if we had enough money, we'd be battling each other. But, luckily the market's big enough, we can all be friends. So if you're under 10,000, that analysis shouldn't be much more than just looking at the Dow Jones Industrial average for the day and going, was it up? Was it down? Okay, it's majorly down. let me go find out of my list of 20, 3 or 4 that were crushed the most. And barring any exceptional information that I find in the news feeds, if it just seems like an overreaction and I know these companies are still healthy, then, take a substantial amount of your outstanding capital and use it to buy those companies. And it's the same thing with all levels. You just get a little bit more flexibility if you're, as you have more money to go from, okay, I'm making a move on 3 stocks to make a meaningful impact to, I'm making a move on 5 or 10, because if you're making a move on more than 10 stocks in a day in the Dow 20 or Dow 30, that you've dwindled down to your personal 20, which you can't go wrong in the Dow. Okay. So I'm not sending you on a mission to fail. If you're making a move on more than 10 in a day, you're doing it wrong. You're just buying. You're not buying right. Makes sense?
Definitely.
So over time, if the market's down, and I have these rules for myself, if the market's down 1%, then I take 3% of all my available cash and I deploy it. And I have to find a way. By 10 a.m., I know the market's down 1%. By 2 p.m., I got to find a way to deploy 3% of my capital. If it's down 1.5%, now we're getting serious. That's a serious market move these days. And I need to get rid of somewhere between 5 and 10% of, available cash on hand. And then if it goes, north of 2, we start getting real aggressive. Probably never in a day and you can make your own rules for this, but always follow those rules and say, gosh, if the market loses 3%, I think my 3% loss on a market means I'm going to take 15% of my available cash and I'm going to spread it over, no more than 6 stocks. So that's how you get in, and you get in good. And I don't need to win, like, hit one out of the park. I just need to beat the market by 1/10% every single day. If I do that, then I've done well. So
Nice.
there's your how to build your list. Questions, thoughts, comments. Does it line up with what you've done historically, Chad?
Not exactly. That was a very interesting, very educational way of doing things. Sorry, I'm having trouble with my video here. No, that was very educational for me. So I appreciate that.
So go ahead.
Usually I would get tips from friends or things like that, and then I would kind of study that stock just to see what they're talking about. But overall, like nothing like that, nothing that detailed like how you did it, which was very interesting. Definitely is going to change my way of finding stocks and building my portfolio.
So, and I've made some errors before. Some of those errors paid off pretty well. The problem with going outside of a Dow Jones Industrials based portfolio for most people is that you get into things where you don't really know financially how the companies are doing. If you're buying stocks where the earnings per share is 0 or it's negative, that better be a small part of what you own, and you better be in this 100K plus category. If you're not, you have no business speculating. And it makes a difference too if you have a constant income stream coming in and you want to speculate. Okay, well, you can kind of do that. You're putting on credit. But it's better almost always. It will almost always be better for you to just stick with the Dow 30 and buy on the dips, and your indicator, because you don't want to spend a lot of time on this. I mean, think about,
Yeah.
For anybody, especially if they've got, 10,000 or 10,000 to $100,000 in the market, it starts to get different as you approach the $1 million mark and certainly beyond. But, how much is it worth in your time to actually go out and know much about stocks if you have $25,000 worth of,
Right.
positions? Probably
Yeah.
not worth your time to look at it every day.
Sure.
So what do? You look for big indicators, and then there's smaller indicators. So you look
Mhm.
at, if you have a Dow Jones based portfolio, and you see the Dow Jones has gone up a lot.
Mhm.
Well, okay, that means that some of the components of the Dow Jones have gone up more than others. And you can go to your portfolio and go, all right, maybe you're buying Apple today at this 25 times earnings and going, that's not 40. They're reasonable.
Mhm.
Admittedly, I sold out of it because I had made some money on it. I was kind of afraid of, Apple
Yeah.
turning sour a little bit, especially as, like everything Apple comes out with, the first day I buy the brand spanking new highest level
Right.
version of it. And
I
I'll tell you, this new phone is the exact same for me
It's
as the last
identical.
phone.
Right. Yeah.
And
When I looked at it, I was like, this is nothing special. I'm not buying it. And I don't see a lot of people buying this, which, therefore their stock will not go up like has in the past. But I have a question for you, because we've talked about how you purchase.
Mhm.
Now, how long do you hold? And I know people out there would probably want to know, like me, when do you know when to sell? And how did you have a stop loss put in place, or what's your formula to help us out with that?
Again, I look at, first I get an indicator of where the market is overall with that
Sure.
Dow Jones. It's hitting me. I can see the whole market going up and down. I usually go and like this is a key thing to do right now too. Go into your stock app. Like Apple has a one that
Yeah.
is is installed when you get the phone. That one's really great. It's simple, and it makes it
Mhm.
so you can click on a stock, see latest news, get a reality check on, what's
Yeah.
the reason behind a quick, a big jump or a dip. But you can go there and just load the Dow 30.
Yeah.
Load the whole Dow 30 and
Right.
put the Dow Jones Industrial Average right at the top. And the reason you do
Mhm.
that is so that you can click it and get major Dow news, and then you can get into, more specific news.
Individual.
Right. Now let's say that you have, there's a number of reasons why you might sell a stock. One would be that you think it's going to go down. Like you have knowledge where you think it's going to go down. A few days ago, I dumped all of my Home Depot and all of my Lowe's stock. Now I'm going to be right back into those companies. I've
Oh
been
yeah.
a major investor in Home
Right.
Depot and Lowe's. I've been a partner of Lowe's in a couple of different ways for a long time, and great company. And there's certainly a lot of things that they have going for them that are very good. Their pro divisions, particularly, are
Yep.
kicking some major ass. But uh, a lot of earnings have come out over the last 2 weeks. And
Yep.
if you look at some of the earnings reports from some of the not small companies, big companies, the companies that own things like Delta Faucet, and you look at the numbers that are coming out from suppliers to Lowe's and Home Depot, it doesn't take a
Mhm.
genius to know that, Home Depot and Lowe's numbers, which come out
Yeah.
mid-November, are probably not going to be all that exciting if a
Right.
good portion of their suppliers are not doing well.
Yeah.
And so that was worth my time because I had seven figures in these companies. to
Yep.
go and start researching everyone I could. Now after November, I forget when it is. I think it might be November 15th, and 30 plus days after my sale, so that I can book it, and then it becomes the new ownership as far as the IRS is concerned. Um, I I'm going to come right back in, and I'm going to pick the right day.
Right. Yeah.
I mean, hopefully,
Or
I say hopefully,
you,
not really, but hopefully on November 15th, they come out with
uh,
numbers and guidance that's not all that great.
yeah.
They dip like Target and Walmart did. That was a great
Yeah.
buying day for me. Recently, they went down about 30% each, and I was ready. You
Right.
always have
Yeah.
cash ready for that.
Right.
I
Amazon. Yeah.
Oh man, that was just a money making day.
Yeah.
And hopefully, it dips, I buy it, and and ride it back up a little bit. That would be
Right.
ideal.
Those
Another,
two,
go ahead.
I was going to say those two stocks are driven mainly too with home improvements, construction, builders. How do you see that? I mean, now that we've taken a turn, those have kind of gone down. Do you see those stocks maybe taking quite a hit? Is that what you're kind of waiting for? Those earnings,
Well,
that news?
the stocks don't even have to take the full hit. What has to happen
Right.
is, in mid-November, when when Lowe's and Home Depot show their numbers, uh,
Hmm.
release their financials, the these products that haven't sold as much, that's gonna come out in their numbers in one way or another. Either
Right.
either they lost momentum, they plateaued a little bit, maybe even shrunk a little. I doubt they got quite there,
Yeah.
but their growth
Not there
rates
yet.
probably slowed a little bit.
Right.
And at the very least, like what we know, as an investor,
Hmm.
what you know, the stake you can't fake,
Yeah.
is that it's not going to be an exciting day when they come
Right.
out with their numbers.
Yeah. Yeah.
It's not like they're gonna,
It's gonna be
they double. No.
no,
Yeah.
no. It's not
So
them.
like if there's eh, like I'm not a billionaire just yet. I don't want to be there for the crushing blows. And
Mhm.
I think that's one of the biggest things that investors bring up is, gosh, how do I keep from losing money? Well, you can't really
Right.
keep from losing money, but you can make reasonable efforts at avoiding unreasonable risk. Uh,
Definitely.
and it's definitely an unreasonable risk right now to own Home Depot and Lowe's with all of their suppliers showing, or many of their
Mm.
suppliers showing bad sales numbers.
Right.
So, but
Yeah,
I'll
I
come
agree.
back into it. Now that's one reason that I would get out, is that, it's about to be earnings season, or, there's something about to happen newsworthy. And, and I kind of have a hunch, can look at other numbers of other things that affect it indirectly.
Yeah.
And, that's kind of a fun game for me. I like figuring that shit out.
Yeah. Yeah, you
But
do.
yeah,
How do
but
you feel like with the interest rate hikes affecting the Dow 30 anymore? Because we know there's a 0.75 coming up on Wednesday, maybe another in December. But how do you feel? Because I know a lot of investors are kind of holding strong right now. They're afraid to invest in anything because of what's going on. So just asking you that, like, how do you feel about that?
well, let me pull something up for you real quick, just to show
Sure.
you the direct and indirect uh, part of this. And this is basic um, uh, basic research that, like, you should know. If you're investing in a company, you should know some things about their financials. So just a quick Google search, luckily these days, and a lot of truth from these Dow Jones Industrials. Like, they're highly regulated. Their financials can't come out and be inaccurate, without some serious repercussions. So, you look at their long-term debt, it's 21 billion. It's only up 3.5% year over year. And you can actually look in even deeper and see the terms of that debt. Um, the terms of that debt are going to be better than what you get as a consumer in all likelihood, because they're a very, they're A-rated and very large company. They're able to sell debt instruments and finance in ways that you and I can't by walking into a bank. So the direct effect of interest rates is not much for now. It would be a big issue if they needed to raise capital and they wanted to do it via debt. But I don't think that that's going to be much of an issue. You've seen a lot of companies on the Dow Jones that have been going back and doing stock buybacks. They are loaded, ready to sell off for capital raises if they need to. I don't think that there's a direct effect on companies. Now, as far as the consumer goes, I think some of the effect is obvious. I think some of the effect is debatable. I got credit cards, you got credit cards. Hopefully you're paying your credit cards off with a reasonable frequency to where you don't even care what the interest rate is, do you? Right? I mean,
I just paid off.
I'm sure
Amex.
Half of them are probably 23% or something like that.
I don't even know. Amex is just ridiculous. Yeah, it's terrible.
So my thought is that when you take that that Fed funds rate and it trickles down into things like like the margins that they charge on credit cards, I don't think that those are affecting consumers as big as people might think. For those that are holding debt, for sure, it's going to adversely affect their cash flow. But for people that don't carry a lot of credit card debt, they're still using the credit card. They're still functioning day to day, and if it goes up or down 2 or 3 points, that's not going to make a difference to the American consumer. And we saw just 2 weeks ago, American Express and Bank of America come out, and then more of the financials come out with numbers. Almost everybody's up double-digit percentages.
Double digits, yeah.
Oh, I wonder why. Could it be inflation? Could it be inflation driven? Could it be just market driven? And and that people are able to get out and do everything that they always did before the last 2 years, maybe. But
building their debt,
that hasn't been affected. The big thing that gets affected, and it affects most of our friends being real estate guys, is mortgage rates. Those have climbed to a point that, oh my God, and it's the weirdest market there right now, because you have these unaffordable mortgage payments. You have housing prices that really haven't come down. You have inventory that, haven't come up a lot. I mean, it's shifting. There's no doubt about that. Competing over one property, that's a thing of the past. But this doesn't seem to have actually affected anything other than we continue to see transaction volume being affected
heavily. People are at a just paralysis right now with it. The sellers are holding, buyers are holding. They're scared.
Oh yeah. Well, and when we go back to 06 to 08, that whole mess, from a real estate transactional standpoint, which is the biggest part of that economy. The biggest part of the real estate economy is not whether snobby Miami condo owners can sell the condo they bought for $2 million 3 years ago for $5 million today. That is not what our real estate economy is based on. Our real estate economy is based on the majority of homes that are in what I call World War II subdivisions, and all of the ones that sprouted off from there.
Yeah.
In your neck of the woods, Diamond Bar, California is very well developed. And
Mhm.
those transactions, those houses going from, one person to another, they're not going through the roof even though they're in Southern California on crazy valuation. They're just houses. And if people can't, there's a whole real estate economy that's really more based on the transaction volume than the price of the real estate. And we'll talk about price of real estate here in a second because I want to, and I feel like we
Yeah.
both good perspectives on this and opposite coast perspectives. So valuable to
Oh yeah.
but the interest rates are making it so people don't want to move because they want to keep their mortgage. So they're, you know,
Yeah.
they're going with alternative ways of dealing with that, and they're renting out their property. So
Yeah.
the world goes round.
Yeah.
But for mortgage brokers, home inspectors, title reps, and otherwise,
Agent.
get ready to have one less Ferrari in your garage. I would definitely sell one Ferrari now, Chad. I know.
maybe two. Yeah.
Yeah. So that's I think on the valuation side, though, what we're seeing, one of these things that's kind of keeping the values high is that, one, people want to keep those mortgages, and two, they just paid a ridiculous amount, or they've seen houses in their neighborhood go for a ridiculous amount. So people are holding out for price, and they're holding out for price on a big level. And this is combined with one huge factor. As soon as COVID hit, what did the federal government do? Oh, you can't be evicted. So,
No moratoriums.
right.
Just
So
dump $1 trillion.
They
So
led
much
to
money.
homes not hitting the market. So there's no like there should be 50 completely trashed out REO homes within 5 miles of your house that are
Yeah.
good flipping opportunities.
Should be coming. I've heard they're coming, but waiting. Supposedly those moratoriums are over and the banks are waiting.
Yep.
So yeah.
So, sucks for us on the real estate side,
Yeah.
but back to this,
Sure.
and it actually leads to one of the reasons why, back to your question of why, when do you sell? Why do you sell?
Yeah.
You might sell a stock position because you need the money. It's just that simple. It doesn't matter whether
Yeah.
it's the right day, the wrong day. If you have some flexibility, then maybe you pick an up day for the week, but when you got to sell, you got to sell. There's another
Mhm.
reason, another two reasons to sell a stock that leads to a timing thing. So,
Mhm.
so let's say that you had to dump a stock, or you made a bunch of money in your business this year, and
Mhm.
you're about to get hit with $1 million worth of profit, and
Right.
you have a stock, and this is going to get complicated here. Okay. I'm sorry in
Yeah.
advance, but you have a stock that you
Sad.
have some loss on. Okay. It's a
Mhm.
short-term ownership. You bought it 4 months ago. You lost 200 grand. You've been watching it. You're sure it's going to come back up, but it was a good long-term play. You analyzed it financially. It was part of the Dow Jones, and you just,
Mhm.
bad luck. You lost a couple hundred grand on it. Well, there's a logical reason at that point to go ahead and book the $200,000 in losses, put them against your profits or your income for
Yep.
purposes of taxes, reduce your tax level, and take a
Yep.
$200,000 loss, take 40% off of that. So you get 80 grand back.
Sure.
And have that 200 grand sitting, or excuse me, not the 200 grand, the whole amount of whatever that underlying stock was, pulled aside, ready to pull the trigger 30 days later, when that same stock, or maybe a related stock, or maybe even a better stock decision,
Sure.
you go heavier in a different position because you're now you have clarity that comes with owning nothing.
Yep.
And, you go out and deploy that capital again, and you deploy it in the best way possible.
So for capital gains tax purposes, just, you sell it before,
you can sell,
take that loss,
take a loss for this year. And, eventually that stuff catches up with you, but it can be many years down the line, and it could be many years down the line after, you were able to recoup a cash position today that you were then able to reinvest. And by the time you're paying the taxes on, the consideration for what you did, you've tripled it. So that's another reason why you might sell. The other reason you might sell is that, you're divesting. Okay. At some point, depending on which category you're in, if you're in the millions, if you're in the millions, you never divest. You never do. You basically let it do its thing. You start trying to live your life based on what that's kicking out, right? You calculate your retirement to the point where, you might dig into this some, but, then, you want to pass things on to your kids or whatever. These people are well taken care of. They're not worried about it. Those dividends, especially 2.9% on Procter and Gamble. Woohoo!
You're doing pretty good.
Oh, dude,
you're killing it.
If I were to tell you the number that Procter and Gamble has paid me for sitting on my ass, it would probably offend you. 100K to 1 million, though, you're probably more actively involved, and you're going to take a little bit at a time and draw that down, right?
Sure.
You're not going to spend a bunch of money on other investments like 65 life policies and whatnot to back this stuff at that level. So so
great stuff.
So now you know where to or what to invest in, when to time it. Now let's talk about methodology, because a lot of people will go out and they will go, man, I can save money by not dealing with a broker. I can go to my, Ameritrade or whatever. And all that's true. But if you have a good broker, and these people do this for a living, and I'm pretty good at what I do for a living. How about you, Chad? Like, are people going to save money by inspecting their own house?
No.
I mean, come on, man. They got to pay you hundreds of dollars, maybe like even $1,000. And just for you to look around. Come on. No, of course they're going to save money. And the average client that uses the elite group in Southern California is going to take a $700 investment in services and turn that into a $1,400 to $3,600 return in terms of seller negotiating points and defect found. So your return on investment is huge. You probably, even if you were qualified to find it, you probably would not have the organized way to go through a house and document it. And you certainly aren't your own third party. So, it makes sense to go with a professional. That, I know that. Yet, do you have a Ameritrade account by chance, Chad?
No, I go through Tastyworks.
Tastyworks?
Yeah, I do. I told you I was doing a lot of options, so I use that platform. Yeah, gotcha. I like that platform the best. Yeah,
fair enough. So here's my suggestion. I suggest if you're under the $10,000 mark, then you should really just be focusing on building that into something that puts you in the next category. You should be participating, maxing out your employer 401k, focusing on the basics, right? Basic financial wherewithal. Look it up on Google. If you're in the $10,000 to $100,000 range, though, you should not be doing any self-guided anything, because if you go to the right broker, they have the systems and the notifications and the guidance to make sure that you're doing all these things that are good from a tax perspective, that probably take their fees and bury them by a multiple. So you get their services are free, basically, for most people.
Yeah.
And if you're at this level, okay, now now you'd be an idiot to put yourself where you have an enormous amount of money for most people, relatively a lot of money, which causes a lot of heartburn when you lose 3% in a day, and then
Yeah.
you start making bad decisions with your mouse or trackpad or voice or finger on a phone or whatever you're using
Yeah.
today. If you have millions, you probably, already have heart problems. Okay. Like you're
Yeah.
not be around for long anyway. So enjoy it. But
Right.
for all these other folks, you want to make sure that you're taking advantage of every possible, tax benefit. And if you're right here especially if you're in that 100K to a million, you're heading for a million plus. There are a lot of great big benefits that you get from companies like JP Morgan and their private client group, and
Mhm.
Bank of America and their relationship with Merrill Lynch and of course Charles Schwab, and like where you'll get preferential loans, preferential
Yeah.
savings rates, all these great big benefits financially to keep your money there. They're really good at it. That
Hmm.
way more than exceeds any rate they charge you to help you manage that, which will vary anywhere from, let's say, overall 2.5% down to as little as 1%, or if you get into the tens of millions, it can get even
Sure.
lower than that. But that's about that's it. Let's keep it basic for
Yes.
now. We'll have a different conversation on another
That's
day.
great. Yeah. What do you, I guess the people probably want to know too, like, what are your favorite, like maybe 3 stock picks coming up in the next, like, what do you have your eye on?
Oh, okay.
And
So,
I know we're not paid,
well,
we're not
okay, and this is
professionals here, but it's
it's
just
all
our,
good. It's all good. So
it's our
this is very,
educational guess. Yeah.
this is timing based, right? And
Right.
you have to keep in mind whether we're on a peak or a valley, and
Yeah.
like
Right.
all this advice expires tomorrow. But let me give
last
you.
Friday was a great, if we had this conversation on Thursday, because Friday
Well,
was
you
a
can
killer.
see I posted a YouTube video where I talked exactly
Yeah.
about the rocket that was taking off, and look at what happened for the next 2
Oh
days.
yeah.
Um,
Friday went up 800. Yep.
yeah, if you're going to talk about this stuff, it's good to be right every once in a while. Um,
Yeah.
so,
A
uh,
little bit.
so let me tell you two companies that I think are just, a good idea to have some money in right now on the Dow 30. I think they should definitely be in your top list of 20.
Yep.
Johnson and Johnson and
Of
Procter and
course.
Gamble. I think they're both they're just such solid companies. They're such solid plays. There's a little bit of an inflation
Yeah.
play here too.
The dividends
Uh,
are great. Yeah.
Exactly. Oh yeah.
Yeah.
Speaking of JP Morgan Chase and Goldman Sachs, American Express, these these big
Inflation plays.
financial companies, Visa,
Hmm.
um, they know how to deal with financial shit. That's what they do all day. And
Right.
in
Yeah.
some to some extent, these are, kind of that, almost in that too big to fail category. I mean, it's just
Yeah.
they have so much, like how could they possibly liquidate? Um, Let me tell you a company I don't like, and then we'll have a very little fun outside of the Dow 30. I don't like Nike on the Dow 30.
Yeah.
I think there's a lot of cheap Chinese shoes out there, and I think
Hmm.
when the market turns crappy, which can always happen, it feels like we're in the 11th inning every day, but we
Yeah.
just
Yeah.
keep going. I feel like the first thing moms stop buying are Air Jordans.
Oh
Um,
yeah. Nike will be stopped. I think they're going to pick up Skechers a little bit more during these days, but
I don't
not
love
Nike.
I don't love Caterpillar for
No.
for the next 5 years. I
No.
think that I think that we've done a really shitty job in this country of saving up, bonding over, being prepared for municipal improvement projects
Yeah.
where, a lot of that equipment, gets used in big numbers. Um,
Yep.
I and then there's let's see, one last one, and then we'll go on to next thing. Um,
How do you feel
sales.
about?
The one that has blown me away, becoming a part
Yeah.
of the Dow Jones, becoming and doing so well, is Salesforce.
Yeah.
Like
Yeah.
Salesforce, like they have been a force to be
Yeah.
reckoned with. And I
Yeah.
think that so many companies are, um, very, very much now reliant on their platform in ways that
Hmm.
they had no idea that they would ever be. So you look at the percentage of institutional investment in Salesforce.
Hmm.
This is a big one. Okay.
Yeah. Yeah.
94.6%.
Wow.
What do they know?
Yeah.
What do they know
what
that we don't?
what is going on? Yeah. What is that?
Yeah, and
What is going
I
on?
mean, as far as they're right at their year high.
Hmm.
They're they keep moving up, and where's their yeah, their price to earnings ratio? Like, God, I hate this one. 307.
Oh,
Okay, so it'll
wow.
only take you 300 years to get your money back, which, by the way, means that the
That's
market has
terrible.
projected that these guys are, they're going to keep
Yeah.
going like
The
crazy.
scaling. They're going to scale. Yeah, for sure.
I just, you look at they're at a 941 million times a million. Their assets are huge. It's like $941 billion. Like they're almost
Hmm.
they're about to click over the $1 trillion company. Um,
Wow.
when we were growing up in the 90s, like how many $1 trillion companies were there? There was none. $1 trillion,
None. Yeah, I can't think of any.
like we didn't have, our national debt wasn't $1 trillion. It was,
Yeah.
this isn't just insane. So anyway, I don't understand why, why you have such a consistent price point, a consistent growth, hundreds on the
Hundreds of.
PE,
Yeah.
and the smartest people in the room somehow are the ones that own it. So
Hmm.
I don't know. Like that one, I
Yeah.
would probably just, I would keep it off my list because I feel like it did already a lot of what it was going to do.
Yep.
And I mean, and where's it going to go? Where's it going to go from here? Now let's
Yeah.
talk about one thing like off the list that I kind of like.
Yeah.
You ever taken any cruises?
Yeah. I've taken a few. Yeah.
Have you taken any
Like,
recently?
no, 2016, I believe, was my last. Yeah.
All right. So I've been
Yeah.
uh taking a few, we'll call it market research. And
Yeah.
but I started upgrading like to, things that I didn't think I ever would. And, you
Yeah.
know, like, okay, I guess I can spend that much on a room for a week.
Yeah.
I ended up really discovering that you've heard of Royal Caribbean, right?
Yeah. One of my favorites. Yeah. They're
You've
great.
heard of their
Yeah.
celebrity line? You ever go on their celebrity line?
Haven't heard of. Is that new?
It's like,
No.
no, that's the thing.
Celebrity line.
I've been riding on Royal Caribbean for years and years, and I had
Yeah.
no idea that there were a whole fleet of boats that were exactly the same, but higher technology, higher finishes, and basically none of the
Huh.
kid stuff, and double the price. And it's called
That's
Celebrity, and it's
okay.
ridiculously opulent. And
Hmm.
there was one cruise I went on that was right after they opened up, where a 3,000 person boat had 312 people on it. By the next month, it had
Wow.
over 800. By the next month after that, we were already to the, COVID limit of half. I mean, we
Yep.
were talking about three months. And for whatever reason, like Royal Caribbean just hasn't come back. Their stock just keeps getting murdered.
Yep,
And like they have such a system. Like
they
I
do.
can't imagine anyone could ever compete with that business the way that they do.
I
So
know. I mean, if you've ever been on a Royal Caribbean, it is the systems they have in place from the minute you board that ship to you leave.
just imagine that Royal
It's done
Caribbean,
very well. Yeah.
but none of the like a few of the most well-behaved of the children are there eating their
Yep.
lobster breakfast, and everything you
Yep.
touch is gold.
Right. Yeah.
It's
Yeah.
it's ridiculous. It's a
So
ridiculous
you
uh
so you feel like their stock will see a good run here based on
well,
because they just been so beat up through the pandemic with everything else. So
well, so this
um,
is one of those things I look at. I'm a big fan of FedEx. I've been losing money on FedEx
yep,
for several months now, but I think it's
me
gonna
too.
do fine.
Yeah.
I know it's gonna do fine because I know their numbers are good. I
Yep.
know that, you could have $100 billion and you could not compete. You could not start a business to compete with UPS and FedEx, period. End of story.
You're right.
Done. Yeah, like
Yep.
they got it. They own it. And I feel like, there's certainly more competitors in the cruise ship space, but to build it up to that point where you have, you know, 20+ billion-dollar ships, like,
Yeah.
wow,
Quite a fleet. That's
oh
quite a
my
fleet,
God.
and they're always full too. I mean, let's like when it's busy, they're busy. They're booking the most, I would
And
imagine.
when it's not busy, you know what they do? Like, they are so efficient. They book a one-way cruise for anybody that wants to go from here to the Mediterranean, and then they send it over to boat
Hmm.
over to the Mediterranean for a little while. From your neck of the
Yeah.
woods, the Pacific side, they're sending it over to Asian countries. You know,
Yep.
it's
Yeah, I've heard that.
incredibly oh, and they pay all their people $4 an hour.
Yeah, that's it's terrible. They work like 20 hours a day.
Yeah,
Yeah,
exactly.
it's there. You see them in the morning at 5 a.m. getting your coffee, and then they're serving your dinner at 8 p.m.
Well,
It's crazy.
I think this is a good starting point.
Yeah.
Thanks for thinking of it, Chad, and we'll do this again soon.
Yeah. I appreciate your time as always. Thank you for the education.
Absolutely.